Good morning, everyone. Welcome to our cash flow management seminar. My name is Pauline Davis, and I am one of the assistant directors at the Small Business Development Center. Welcome, welcome again. Today, hopefully, we will impart some information that will help your business to grow. Once again, my name is Pauline Davis. And a little bit about me, I'm one of the consultants here, have been at the SBDC for quite a while. I'm an accountant by trade, really enjoy working with numbers. In the past, I've taught many seminars and I've had one-on-one consultations with clients. Cash flow management is really up my alley in terms of giving information to business owners, because as I said, I'm an accountant by trade and I love my numbers and they have never disappointed me. So with that, we have Jose Molfino. He's one of our business consultants. And we also have Elliot Wenthal. He's gonna be our technical advisors. And gentlemen, introduce yourselves.
Thank you, Pauline. Thank you all for attending this meeting. My name is Jose Molfino, and I have worked with a few companies already in my professional career, from small to Fortune 500 companies. I have international experience working in the US, in the Middle East, in Latin America, and I have been with the SBDC for a few years already. First as a volunteer advisor, and after looking closely to the great impact that this organization has in the business community, not only in Florida, but throughout the US, I was able to join the ranks as a business consultant a year ago, and I'm very glad for that. I'm glad that I am able to share my expertise with the business community, especially in the areas of business strategy, financial management, including long-range plan, budgeting, cash flow, accounting, logistics, operations, and process improvement in general. Glad to have you with us today. Elliot?
Good morning. My name is Elliot Weinthal. I am a pretty recent graduate of UCF. I've been working with the SBDC for almost a year now. My specialties include startup, pivoting, finding alternative markets, and research, whether it's market, industry, or academic research. I will be running the technical side of this webinar today. And for those that just joined us, just some more housekeeping. Everybody will be on mute for the entire webinar. We will answer questions at the end of the webinar. Please use the chat or questions feature in the menu that should be either on your right or left built in, and we will get to them at the end of the webinar. And with that, we'd like to get some information about you, and we'll start some polls. I'll close it in about 10 seconds. All right. So here are the results. The correct answer is actually Neptune and Uranus. Scientists have recreated the scenario, and actually it does rain diamonds there. Next question. Or close in about 10 seconds. Here are some of the results. Next poll. I'm going to close it in about 10 seconds. Here are the results. Keep it up in about 10 seconds. And last question before we get started. We'll close in about 10 seconds. All right, and with that, Pauline, let's get started.
Okay. So I would like, before I get started, I would like to acknowledge TD Bank as one of our sponsors. They recognize the importance of cash flow. And so recognizing the importance of cash flow, they have decided, to give us a sponsorship for this webinar. So a little bit about the Small Business Development Center. Our physical office is at the Fashion Square Mall on East Colonial Drive. Because of the pandemic, the office is not really staffed at this moment. So most of the time we do our consulting online between Zoom and talking to our clients and managing the best way we can. So as I said, physical location is at the Fashion Square Mall. The SBDC provides technical and business services to people who want to start a business, as well as those that are already in business and want to strengthen their business. It is our hope and understanding that, the American economy thrives wholly on small businesses. So we want to make them as healthy as possible. Our services range from one-on-one consulting to training to just about anything that we can do to assist you. And services that you may need that we cannot provide, we will usually find the resources so that you can get those services that you need. So a few of our really high excellent service is our growth acceleration services. And basically that's for existing business owners. You are growing your business and you want to get a better in-depth understanding of what's going on with your business. We'll take a close look at the business. We'll review your financial statements. We will process it through software that we have to compare you to your competitors and your industry to make sure that you're operating most efficiently. It doesn't make sense for you to grow a business that have a problem. You know, if you're at 500,000 in revenue and you want to grow that business to $1 million, you want to make sure you correct a lot of the deficiencies before you try to take it to that $1 million, so you don't expound on the problems that you're having. Then there is our Advisory Board Council. That's an award-winning national program. And just like how you have large corporations have advisory board councils, we put together an advisory board for small business owners, and it's designed specifically for them to address the different problems they may have. And your board will meet with you on a quarterly basis. They will help you do analysis. They'll listen to you. They'll offer you their expert advice. And keeping in mind that this is still your business, they're just advising you. But we find that clients really, really appreciate and excel so much once they have had an advisory board council. Then we have our CEO exchange programs. You know, running a successful business or running any business is very, very lonely, especially at the top. So our CEO exchange, it's a program where CEOs, business owners, get together on a monthly basis, and they can talk about the challenges that they're having. They will keep each other motivated, answer each other's questions, and just being able to have that interaction with like-minded people. Then our international trade service. If you want to take your business to the next level, say you want to grow your business and you're thinking about exporting to Australia or Canada or Europe, you know, you understand the national US market, but you may not understand that it's international market. So with that program, our consultants will help you with information, research to tell you, you know, what are some of the limitations in these markets? What are some of the rules? How does it work in Canada? And what's the best way to proceed? So that's our international trade services. And they'll also tell you about, you know, finances that may or may not be available to export your product. And finally, our government contracting services. That if you want to sell to the government locally, state, national, this program will help you to understand the process. So everything is a process, and you know, especially when we're working with the government, there are forms, there are ways of doing things. So the government contracting services will help you to know, okay, what kind of collection procedures do I need? How do I find a bid? How do I actually bid on some of these opportunities? So these are some of the programs we have for our emerging and small businesses. And once again, as I said, all of this is very low cost. Most of them is free, actually. So we want you to take advantage of these programs so that, you know, you can grow your business. We also have a new services that we have where it's business valuation. You have been in your business for a couple of years, so now you want to know what your business is worth. So at least to start thinking about what you want to do with your business in the future, we can help you by doing a business valuation for you. So once again, take advantage of our services. Just email us, call our office, and we'll be more than happy to work with you. So to move on to our next slide here. All right, so we're talking about cash flow. So with this agenda, first we're gonna define cash flow. Who is responsible for your cash flow? That's always a very interesting question, because many business owners will say, I am paying an accountant, a CPA, a lot of money to take care of my finances. Well, your CPA is not really responsible for your cash flow, because your cash flow is a future type exercise. So your CPA and your accountant is usually looking at what happened in the past. Your cash flow is helping you to predict what's going on in the future. So no, I would not rely totally on my CPA to help me with cash flow. So that's going to be up to you and your employees, your owners, whoever it is that you have set up. But certainly not your accountant is responsible for your cash flow. And then we'll talk about the cash flow cycle, financial statement analysis. How do you prepare a cash flow projection? And then give you some research material. Well, how do we define cash flow? Really, the cash flow is the revenues that's coming into your business versus the cash going out of your business. Cash flow, positive cash flow means you have more coming in than you have going out. Negative cash flow means you got more going out than coming in. When you have more cash going out than coming in, you have a problem. And so for this discussion, I would also include in cash flow, if you're selling with credit cards, I would consider that cash. If you are some of those lovely cash apps that's out there, where you get your money with a ding and within 24 hours, I would also consider that cash. So as a business owner, to be successful, you really need to be able to control your cash flow. The market is changing. We're in a very unusual business climate, and those businesses that are going to be successful and to survive this business environment, cash is king. So there's two types of management we find over the years. We have what you call a reactive management, where there's always an emergency. This is Wednesday and you get your payroll report and you have to pay your payroll on Friday, and you realize, okay, I don't have enough money to pay my payroll. What am I going to do? So you get up and you try to call everybody, I need this, I need that. So that's reactive management. Proactive management means that you're anticipating the problems. 2 weeks before, you have a good idea how much money you're going to be collecting and what your payroll is going to be. So you're not reacting. There's not any surprises. Hopefully this seminar will help you to be more proactive, anticipate those problems, not trying to react to them and constantly in that mode of confusion. So with cash flow, we want to be proactive, not reactive. Cash flow cycle. Now, the cash flow cycle is going to vary depending on what industry you are in. Some industries may be in more, your retail industry, your cash flow cycle is going to be shorter. Maybe you purchase some goods, you have some inventory, you have some payables, then you sell your goods, you collect your money right away. If you're in a manufacturing environment, once again, you have some purchases, you purchase the goods, then you have the materials, the inventory available, then you create yourself an accounts payable, then you go into your production cycle, you have your finished inventory ready for sales, and then, but before you even have the sales, you have quite a bit of money tied up between purchase, inventory, and manufacturing the product. So you have to figure out all this money that you have tied up, what's going to happen. And then here you have your sales, you have created an accounts receivable. Maybe your sales terms is you're not going to collect your money for 30 days. So it's going to take an additional 30 days before you get back to this cash cycle. As a business owner, you're going to have problems if you don't understand your cash cycle. Many times as business owners are trying to get started, they'll say to me, well, Pauline, how much money should I have in reserve? And I'll say, well, I can't really tell you that. The answer is you have to look at your cash flow cycle. When money comes in, when money goes out, and what you need to do in between that process. So with cash flow cycles, timing is everything, because you could really have a large sales and everything looks good, you know, you're profitable. But if the timing doesn't line up, you could actually put yourself out of business. Growth takes money, business takes money, and so really you totally have to understand your cash flow cycle and build in some extra time for whatever could possibly go wrong. Then cash flow, usually what's affecting the cash flow, you know, inflows, you're gonna have your sales, loans that bring money in the business. I wouldn't really recognize I would not really recommend that your cash flow cycle is going to rely heavily on loans. You borrow money, you got to pay it back. Maybe you have some new investment, somebody's investing in your business, maybe you sell some fixed assets, and of course, from operating profits. Then what affects the money going out? Well, as a business, you have expenses. You got to pay your rent, your employees, utilities. There is, there's bills to be paid. And then inventory, maybe you want to stock up on inventory. You're getting your products from China. So you know you have to, there might be a 90-day cycle before you get your product. So you have to have some inventory. New investment, you want to invest into something else. You have to pay your debt. You borrowed money to start the business. Maybe you have a mortgage that you have to pay. And then your owner's lifestyle. The reason why you're in business is so that you can create a certain lifestyle for yourself. Well, so if you don't have enough cash flow, you know, that could impede the lifestyle. But always remember that the owner is the person that gets paid last. So you got to pay everybody and pay everything before you look at your owner's lifestyle. So cash flow, really understand what are the transactions that affect the inflow and what are the transactions that affect the outflow. Cash flow objective. Your cash flow objectives should always be that your inflow is going to exceed your outflow. If your outflow of cash exceeds your inflow, you are out of business no matter how successful and bright everything looks, okay? So your objective always is to stay ahead and make sure your inflows exceeds your outflow. And once again, as we say, timing is everything. If you're expecting $1 million next week, but you have to pay the rent, your employees this week, that $1 million is not really going to help you. So you have to look at your timing and how you're going to do this. And with that, Jose will talk about how do you manage that cash flow.
All right, thank you, Pauline. If there is a big takeaway of this webinar is that we want to use a cash flow forecast in order to avoid surprises. So you don't want to have surprises. That's one of the main points that we are trying to make and to pinpoint the importance of a cash flow. You will see, or you have seen probably a cash flow statement coming out of your accounting system, or your accountant or CPA has provided you with a cash flow statement. Most of the time, those cash flow statements are a backward look. So they see how the cash went in or went out in your company in the last few months or years. So it look at the past. What we want to stress in this presentation is more onto a looking forward picture. So how to prepare you to put together a forecast for the next 12 months so you don't have surprises. The key information to do a good forecast is normally your financial statement. You want to see your income statement, your balance sheet, you want to see your account receivables, specifically the aging, and your accounts payable as well. And the cash flow forecast exercise that we will present to you will have three components, and we have put this together in order to analyze the data in the most effective way. The first component is cash flow from operations, or understand all the implication that your company has in terms of the operating activities, all the sales, all expenses. So what is the amount of money that the company is generating or consuming in terms of cash without entering in any part of financing or investing activity. The second component is to understand what is your debt strategy. So how you are managing your debt, if you are paying back loans or you are getting new loans. That's what we call cash flow from financing activities. And then the third component will be your asset management. If you are buying new asset, or you are taking down assets that are no longer productive or you are not using and you want to sell off. So that is the cash flow from investing activities, how you investing in your company for the future. The cash flow projection, the key is to have some historical information. You need to know your numbers. Many people rely in their accountant to prepare the statements, but it's important as an owner or a CEO that you are able to understand how the numbers are being generated, why you have that specific amount in each specific month, so you are able to project what is the future and how the future is painting out. It's important to understand the timing. The timing is basically will play an important role on the revenue side and on the cost of goods sold side. Let me explain to you what I refer to timing. If you're a manufacturing company or you are offering services, the moment that your inventory leaves your warehouse is the moment that you normally recognize the sales, or when you offer the service, that moment that the service was offered, that's the moment that the sales or revenues recognize. But if the company is selling at sales terms, or let's say 30 days, the cash will not hit the bank account until 30 days later. So that is a difference between what the number that you see in an income statement and the number that you see in the cash flow. In an income statement, the service or sale was recognized in November, let's say, but the cash will not come until December. So that's the timing that play a role also when you buy products or services. If you buy a product in one specific month, but that vendor, you negotiated a payment term of 60 days. So the money will not be withdrawn from your bank account until 60 days later. So that's the timing that we normally try to make sure it's correctly put in a cash flow forecast. So why we are getting those statements in order to generate and forecast a cash flow. This is the business cycle, and I want to explain what is the role that each statement play in any type of business. The moment that you really decide to put a business together, the main component that any person will need is to buy assets. The assets are the one that generate sales and provide profits for you. That's the moment that you decide to put together a company. Is asset the first activities that any entrepreneur will purchase. So how those assets are bought, it depends on who is putting the money. If the owner is putting the money out of their own pocket, that is what is called network or equity. If the money is being put by third parties, being through loans or credit coming from vendors, that's the liability part. So that equation, which is asset, is equal to liabilities, but network plus network is the balance sheet equation. And there you will see that when we work on the cash flow, your asset management will be there, your liability or debt management will be there, and the timing aspect, because the balance sheet will have some of the components of your account receivables and your accounts payable, and it will explain the timing component. Then when you decide to buy asset in order to generate sales, you want to deduct all the expenses and get profit. That's the reason you put together a company in the first place. And those profits will have three main uses. You will use it to buy new asset if the company is looking for new market, it wants to grow. Most of the time you want to reinvest the profit back into the company to buy more assets, meaning could be more inventory or you need more cash in order to finance more to your clients. You can decide to use that net profit to pay back the debt that was originally put together in order to buy the assets, or pay back to you as an owner, normally through dividends or other means. So that's why it's important this component in the cash flow. The income statement normally will generate the cash flow from operations, and the balance sheet will provide the timing and the debt and asset management components of the cash flow. This is an example of an income statement. You normally want to have some historic information. This company we have year 1, year 2, and year 3, and we have one column that reflect the income statement as a percentage of sales. We always want to have that because you want to recognize what is the cost structure of your company in terms of sales. So this company, for example, the revenue was $1.5 million in year 1 and is growing to 1.6 and $2.1 million in year 3. The cost of goods sold has gone also up as a reflection of the growth of the company from 1.2 to 1.7 million dollars. But you see, for example, that the percentage of sales has gone up as well from 78.95% here to 81.48%. Normally, when you are growing, you want your cost of goods sold more or less to remain at the same percentage level or even decrease because you get more efficient, you get economies of scale. You see the material has gone from 39.47% all the way to 44%. So this company is using or more materials being less efficient, or the price of the material has increased and they have not been able to pass that increase as price increases to the customers. So you see a deterioration in the cost of goods sold and therefore a deterioration in the gross profit from 21% all the way to 18.52%. So these are the expenses, operating expenses. Normally, in the majority of the business, the operating expenses are predicted over time. It repeats at a constant rate, more or less are represented by fixed costs. And in order to project your cash flow, that's one of the easiest part because you can really know what are the numbers that are coming each of the months in terms of operating expenses. So this company went in terms of operating expenses from $247,000 all the way to $346,000, 16%, 16.73% in year 1 to 16.38%. Normally, if you increase or you grow sales, you want your fixed cost to decrease as a percentage. this company has decreased, but not that much. And in the case of interest rate, it has gone up from $26,000 all the way to $49,000. So this company is really financing the growth with debt. You see it's growing, but the debt is increasing because they are paying more interest rate every time. The net profit before taxes is $54,000, down to $6,000. So with more sales, this company is generating less profits. It went down from 3.58% all the way down to 0.29%, so less than 0.5%. So growth is not always good. I mean, it's important to manage the growth with a plan in order to know how to grow and what are the trade-offs of that growth. The balance sheet is accompanies that income statement and explain how it's going. Cash is decreasing from 41,000 to 12. Account receivable is increasing. Inventory is almost doubling from 212 to 419. Fixed costs fixed assets more or less remain the same. Debt is increasing from 52 to 282, and payable from 99 to 310. So this company is financing the growth with short-term debt, which is not a good idea. Normally, if you are growing, you want to finance as much as possible with long-term debt. In this case, it's not happening. Its long-term debt is, on the contrary, decreasing. So that's important to understand the numbers. The next step is your aging, your account receivable. Remember that we saw $270,000, but only $82,500 are current, meaning that if you have, the company has a sales term of 30 days and the customers are not paying in time, every day that is after the due date has come is money that is the cash is not coming in and is becoming due 30 to 60 days, all over to over 90 days. So this company has $100,000 of due, past due of clients that has not honored the sales term that was negotiated. Also, this company is doing the same to the vendors. Only from the 310,000 that has payables, only 100 is in terms, and the 2/3 of that are overdue. So you see the stress that this debt is generating into the company. So this is a first example of how a cash flow exercise is done. I don't have enough space in the slide. I will show you later on how the cash flow for this company will play out. This is just an example of 3 months to show you how we built the cash flow and the tool that we can share with you if you decide to work with us as a consultant. First part is your cash flow from operations. So this is all the inflows and outflows that any given company will generate by itself. In this case, you have the collections and the purchases that this company is having, 50,000, 80,000 for a total of 180 in this quarter, but it's buying and paying more, probably because it's filling up inventory. So it has an outflow of 480 in payments with a gross cash of 300 that is consuming. You have the operating expenses that normally repeat over time that has a total of $261,000 in the quarter as a deficit. So the cash flow that this company is generating is a deficit of $561,000. So how a company can maintain this deficit? So let's see if there is other strategy apart from the operation. And we have the debt management strategy, that is the financing activity. So this company is taking new loans for $800,000 and starting to pay that loan at a rate of $18,400 each month. So the net cash inflow coming from its debt strategy is $763,000. What is the investment strategy? This company is buying $45,000 of new assets in order to pump up the growth. So it has an outflow of $45,000. So the net cash of this company in this quarter was $156,000. It started with $5,000 in the bank account, and because it generated $332 in October, the bank account balance went up to $337. Then it decreased for $127 to $209, and then another $47,000 to $161. So the quarter it ended the balance on $161. How it financed the growth? By additional debt. So I want to explain a little bit the timing part that I referred before. In the collection side of your cash flow, what you want to really reflect is the change between sales and collection. Let's say, as I explained before, this company is selling an item for $30,000 in November, but it has 30 days of sales term, so this sale will not hit the bank account until December, which is 30 days later. That's what you have in your cash flow statement or forecast as well. And the same happened with the payments. This company bought services for $10,000 in October, but it negotiated a payment term of 60 days with the provider. So they won't see the money until December, when the money is withdrawn from the account to pay the vendor. So that's the payment part of the cash flow, the purchase part of the cash flow. It's important to have a dashboard, which are the main metrics that any type of company want to have in order to make sure that whatever numbers is forecasting, it makes sense from the point of how the company is positioned versus the competition. If you are paying a payroll of $100,000, which is 25% of the revenue, is that a good number or not? Always comparing versus a benchmark give indication if one is as efficient as the competition or not. So the dashboard will have a couple of components: key indicator for a company, and then a comparison of that indicator versus the industry. We at SBDC have information about the industry. We can generate a report to you of how the metrics on any specific company compare versus the industry and see how efficient that company is. This is an example of 14 metrics that are key for any type of company. Not all the companies need all these metrics. If a company doesn't have inventory, doesn't need the inventory metrics, or if it doesn't have account receivable because it's selling in cash, it doesn't need that. So a couple of examples. When a company, you want to see the strength of the company to pay the current liabilities or the debt that has to be paid in less than 1 year, you want to see how the strength of that company in their current assets. So for each dollar of current liabilities, how many dollars that company has in current assets. This company had $1.7 for each current liability 2 years ago. In the second year, it had 1.1, and it went down to 0.99 in the most recent year, or year 3. The industry is at 1.8, so it shows that the competitors are more strong in terms of managing their debt than this particular company. If you see the debt to worth is total liability versus the equity, and you see this company went up from 1.5 to 2.68, that means that the debt has increased, and you have seen the debt increase in year 3, but the competition is at 1.2. So for each dollar of equity, the industry has $1.2 of debt. This company has 2.68. Inventory, for example, it went up from 64 days to 86 days, and the industry is at 74 days. So you have 12 more days of inventory. What does it mean? I mean, in order to buy inventory, you need cash. And if this company doesn't have enough cash and is looking for cash from debt, then it's increasing the debt to have inventory that doesn't need. So it's consuming the cash and financing that cash from debt, which is a no-no in this case. You want to be as efficient or more efficient than the industry. Let me give you a quick example of a cash flow for this particular company. So we are forecasting the year 4 for this company, and we will start to understand how to come up with the collection part. This company is going from $2.1 million in year 3 to $2.5 million in year 4. That's the forecast. This is how we are moving from sales to collection. This company decide to negotiate with their customers and get payment from the account receivable that, remember, was $270,000, and negotiate that it will get $40,000 from their clients in the week 2 of month 1 of year 4, then another $82,000 in week 4, and so forth. So we are projecting the $270,000 that will come during the next 3 months. And then the rest of the sales that are coming from 4 customers in this example, 5 customers. If I add all the 12 months, that's the $2.5 million of sales. It's at 30 days of sales, so you will see that these sales will reflect or will hit the bank account 30 days later in this particular case. So the same goes with the purchases. This company is negotiating with the vendors and will pay all the remaining of the $310,000 of accounts payables in the next 3 months. And you see how this is coming to play. And this is the reflection that comes in the cash flow as payments. So all the operating expenses that the owner will come in the next few months. So this company will have a cash flow from operating activities that is positive most of the month to a total of $132,000. But in 2 particular months, in month 2 and month 3, it will have a gap. So we have to see if that gap will be covered. This company was paying interest in $4,125, and it will take additional loans for $100,000, and then will increase to pay the interest because it's paying that new loan, and will pay back that loan in month 11. So with that, the cash flow from financing activities will be a negative total of 54. It took 100 and pay 100, and no new assets, and it will end up, it started with $12,000 on the bank account and will finish with $90,000. But you see no issue with the bank account. But what happened if this company didn't have this loan or didn't forecast to negotiate this loan with the bank? Then you will see that it will have a gap in their bank account for 7 months without money. So that will bring stress into the organization. If you have a cash flow forecast, you realize that you need to have this loan. It could be working capital loan, it could be a credit line, whatever, but it was able to negotiate this $100,000, and then, you know, it can pay back in month 11 and no issue with the cash flow or the bank account. So that was an example of this company in year 4. And I'll go back to Pauline to provide the main takeaways of this presentation. Pauline, back to you.
Okay. So basically, we have given you a lot of information. And I know, although we're doing this remotely, I can see your eyes glazing over from the numbers. But the SBDC, we are here to hold your hand and simplify the process. We want to make it very, very simple for you. As Jose mentioned, that, you know, the key to all of this is your historical information and your future projections. Most of the time, you know what your responsibilities are in terms of, you know, your monthly payments. You know, for the future, what you're selling and what you're hoping to collect. And all we are doing is putting this information together, or assist you in putting the information together, so that, you know, we're taking all surprises out of your operation. So the SBDC, we have consultants here, experienced consultants that can help you with that cash flow. The reason why 90% of businesses fail, and that's high probability, is not necessarily that they had a bad product, not necessarily that they were poor business people, but they just plain ran out of cash. And once, as we said, once you run out of cash, you're going to have a problem. In the initial getting to know you, Elliot asked a couple of questions. Well, on Earth, we don't rain diamonds. It would be nice. That would solve all of our problems. Well, probably if we were raining diamonds, then they wouldn't be worth as much. But we don't rain diamonds and gold. So that's not going to help you much. But, you know, getting the information, reviewing your financials, understanding the life cycles or the financial cycles of your business, that's what we want to help you with. Oh, and before I forget again, we want to thank TD Bank for their sponsorship. They understand cash flow. So what I'm going to do now is just turn it back over to Elliot. We'll have a brief question and answer session. And also you will get an survey sometime between today and tomorrow, asking you, you know, about the presentation. Please answer it so we can always be improving. So that wraps it up for us, but just please reach out to us. Our services are free and we'll be more than happy to assist you. Elliot?
Yeah, so please use the chat feature, the questions feature, to ask questions. We will be keeping everybody on mute. Some questions that we did receive already. This presentation has been recorded and we will be posting it to YouTube. So you can access the presentation through YouTube. If you go to YouTube, our channel is Florida SBDC at UCF. It should be up there within the next 48 hours. Another question we received is, where is the start of the cash flow cycle?
Where is the start of the cash flow cycle?
Yes, that was one of the questions.
Okay, it depends on the business and the type of business that you are in. So, you know, you're in a business, hopefully you'll carry some money in the business. So that's the start there. You will buy some equipment or buy something to sell, then you'll sell and hopefully collect your money. And that's the cycle. It gets a little bit more in depth depending on the industry and the type of business you are in. Jose, you have another take?
Yeah, it's as you said, it's normally when the operation is already coming in. It's already stable. At the beginning, you probably are ramping up the operation, but when it's stable and you have already the business cycle in place, you will see how the cash flow goes after a few months that the process has been stabilized.
People are asking about the template for the spreadsheet template you showed.
Yes, we will share with you that template. Normally, what we want to do is offer you the service to help you put together the forecast. Sometimes it's a little bit complex, although it's not a complex process. but we can help you put the correct numbers and answer any type of question you have. Once you are part of our client base, we will share this tool with you, and we will make sure that the forecast is as accurate as possible.
And then another question would be, if I don't have any history or data, how do I go make projections without any prior history?
Well, if it's a business that is just getting started, this is where your research comes into place. You know, you will have to do the research to see, okay, where do you want to open, what your potential rent is going to be, your product cost, your overhead, who you're selling to. And those are the information that you'll put together to answer those questions. If you're a new business owner, you know, you would have had information that you researched before. So those are the things that's going to help you to put together. 90% of potential business owners, once they do the research, I could tell you a lot of them have decided that they're not ready yet to start a business. So, but we can help you on a one-on-one to see where you are at and try to help you put something that's going to be specifically targeted for your business.
We had a question about a book or other resources for learning financials. Schedule a meeting with us. We are that resource. If the terms of the client is payment upon completion or receipt, but they pay late, how should that be accounted in the cash flow? And then would it be best to change our terms to account for delays?
Well, the cash flow has to reflect reality. Because if you want to put together a forecast, you need to make sure that that forecast reflects the movement of your bank account. So if that customer is paying late, you want to reflect that as it is. Now, the idea is if you want to improve efficiency on your company and be as good as the competition, you need to make sure that your sales terms are similar to the competition and your clients agree and respect those sales terms. That's part of the negotiation that you need to include in running your business.
How do people sign up for a one-on-one?
Well, simply go to our website, www.sbdcorlando.com, and fill out a request for counseling form. And once you fill out that request for counseling form, you can request this particular consultant, or if you don't want to request a particular consultant, one will be assigned to you.
All right, we have 2 minutes left. If there's any other questions? How often should the owner be on top of the cash flow? Any best practices for routines?
Yeah, normally you want to review at least on a monthly basis. If you are a startup, you normally want to do it on a weekly basis. When you are an established business, you want to have at least a monthly review of all your financials, including the cash flow.
Your cash flow is going to tell you so much about your business. And this is where it's going to help you to work on your business instead of in your business. If your business is really going to grow, these are some of the foundation stuff that you have to do. A cash flow is a must. Being intimately involved with your income statement and balance sheet, you must do that. Don't be intimidated. And once again, we're here to assist you with that process.